Hello and welcome to today's SNAP section, Industrial Challenges and Solutions for COVID-19. I'm Paul Rasta and I'm the Executive Editor of CBRE, and we're very pleased to have everyone in the audience with us today. Our special guests today are Patrick Senter, who is the President-Elect of SIOR and an Executive Vice President at CBRE, and his colleague Amy Broadhurst, a CBRE Vice President and fellow SIOR. They are colleagues and work together on the same team at CBRE. Great to have both of you with us. Thank you for joining us today. Before we jump into today's conversation, however, I'd like to let our audience know that we are recording today's program and it will be available for viewing later. Also, we're going to leave time at the end of the session for Patrick and Amy to answer your questions, so please feel free to submit them at any time during the program. And in fact, I'd encourage you to submit your questions as early as possible, so make sure it will increase your chances of getting through to Patrick and Amy. Now, as we all know, the COVID-19 pandemic has left no corner of the country or of commercial real estate untouched. Today, we turn our attention to the industrial sector. In recent years, industrial properties have evolved to meet the changing needs of the economy, and as a result, the sector has attracted consistently strong investment, development, and leasing activity. In light of the challenges raised by COVID-19, however, industrial real estate unexpectedly faces new questions about such issues as the supply chain, stepped up online shopping, and market performance. So let's set the stage for our discussion and take a quick snapshot of the market. I'd like to hear about your top-line expectations for the industry's performance over the next 6 to 12 months, and specifically the industrial sector's performance over that period. Amy, how have the prospects for investment, development, and leasing activity changed to this point in light of the COVID-19 pandemic?
So thank you, Paul. I really appreciate you taking the time out for this today. I would say that, generally there has been a strong demand for the industrial warehousing sector over the past few years, and that has been because of the surge and increase in the e-commerce market. And so what's interesting is that obviously has continued, albeit slowed down a little bit. However, there has been an increase, obviously, in shipping volumes for grocery, pharmaceutical, and home improvement items, which was all seen within the first quarter of this year. So obviously, the demand for those essential goods will continue to increase. However, there will be, I would call, a right sizing in the market, just as we see consumer spending has been so poor over the past couple of months. Unemployment has increased, however, it is believed it is leveling off, and we're currently in a position where there's going to be continued reduction in consumer spending or in purchasing capacity. And so that will eventually level off in the warehousing and distribution market. So you will see some filter down effects that occur with warehousing as some of these retailers go through mergers and acquisitions as well as bankruptcies. So that will definitely impact the demand that we see over the next year. However, I don't really see it impacting much from the investment and investor standpoint. From the demand, that is, from the financing, that's a completely different story. But for demand, I would say warehousing and distribution continues to be the safest bet for a lot of investors just because of the growth that we're seeing into e-commerce and just-in-time demand for groceries and pharmaceutical items as well.
Yeah, Amy touched upon the retail question, and even though we're here talking about industrial distribution, we have to be cognizant of what is happening in the retail world, because when you really look at the tenant rosters for some of the major distribution facilities across our great nation, you see a lot of retail names that right now are either on the verge of going bankrupt or are already in bankruptcy, or in some cases are already shutting down. And it does appear as if the next couple months will be very telling to see whether these retailers reorganize. And if so, hopefully vacancy in the industrial market will continue to be strong. But if not, there could be a resulting uptick in vacancy if too many of these retailers go under.
And I just want to add quickly too, I'm very much a conspiracy theorist for many different things, but I do believe it'll be really interesting to see how the the purchasing, how our purchasing habits change after all this, because it's really gonna, it's really gonna be telling to see how many individuals start pressing towards the demand to have a lot of their goods faster, since we're so used to getting our convenience items within a 24-hour time frame. So I think adding that to the mix might also adjust the picture over the next 12 months as well.
So clearly a lot of moving parts on the retail side that potentially have a chance of influencing what's happening in the distribution and warehouse and industrial sector as well. Well, let's drill down a little bit and talk specifically about space. What's your view of the way that the need for space is changing, and is it evolving in other ways? Let's take one example. Do you see industrial property operators looking to expand capacity at last mile facilities right now?
So that's an interesting question, and I think it's still a little bit early. And again, it all depends on the size of the company, the industry, specific locations they're currently in, and how they are operating. So I think there is already an increased demand for refrigerated space and grocery goods. As we're seeing, there are a lot of companies that were impacted by that have been impacted, a lot of farmers that have been impacted from the produce sector and have gone bankrupt. And over time, how is that going to impact the demand for grocers' goods, for produce, et cetera? How do they store that? How do they store those items? And I do think also pharmaceuticals are going to increase in the near term as well, just because of COVID and the extended impact over the next 12 months. So, from that standpoint, I see it increasing. I also do believe that there are going to be a lot of what I would call convenience items that start really transferring to these last mile facilities, just because now that we are more inclined to buy our groceries via Amazon Prime or whatever, whatever your source might be through your local grocer. That is a trend that never existed prior to COVID, and there needs to be a source of those products closer to the end user. I also think it'll be interesting because I think some of these retailers, as they're adjusting along with the grocers, they can use a lot of the pre-existing retail facilities to support this need. So how much expansion we'll see with last mile facilities will depend on the specific retailer, the specific industry, and also again, I would say too, with a lot of the e-commerce companies, I think they will continue expanding just because the demand has already pre-existed this.
Yeah, and it's interesting, and again, I don't want to sound like a doom and gloomer, because candidly, I'm still very optimistic on where our economy will be in a year from now. But not only are we dealing with the bankruptcies associated with retailers, but there's a lot of smaller manufacturers who are some of the suppliers to major corporations, whether it be a parts for the auto industry or the oil and gas industry or whatever the case might be. There are a number of these smaller companies that are very, very key to these industries. And if they tend to go out, that also could have an impact on space that would be coming available. And in turn, these manufacturing companies are going to have to do something additional going forward as it pertains to the supply chain, which I know we'll talk about in a little bit. But it's not just with distribution, it's also with manufacturing, because again, these small manufacturers are going to have to be able to stay afloat for the next couple months in order to continue the growth that we have seen in the industrial and manufacturing markets.
Well, you're both really raising a point, I think, that leads to our next point of discussion, which is about the facilities themselves. What are you seeing out there about the potential for changes to the configuration of warehouse and distribution facilities, for example? First of all, are there modifications that you expect? And if so, what about the financial responsibility? Will it be the operator or the tenant, the occupant, who will generally be responsible for making modifications to properties, especially, again, in light of what's been happening with the COVID-19 situation?
So I would say that, interestingly, I mean, this is an ongoing concern for a lot of companies. So this is something that they're constantly thinking about. The facility and location of the facility has always been driven about efficiency and cost reduction. And so I think, it goes back to the industry question, what specific item is going to help them avoid future risk, but also enable them to reduce cost? And that's really going to be business dependent. However, items such as ceiling height and loading have always been a concern for some of these firms, but what we've noticed, and I would say even more so in conversation than was previously now, is automation. And automation really helps companies avoid the risk of labor issues. That honestly opened more eyes with the COVID era because of its sweeping impacts across the globe. So automation has been one of the biggest components that we've seen companies talking about investing in, to the extent of going fully automated and enabling them to really reshore a lot of their manufacturing as well as production. Now, again, that automation can be implemented across many different fields, so it just depends. And locations of facilities as it pertains to automation are really going to be driven behind the most important factors that are related to that automation. So whether it's rail, whether it's air cargo, those sort of items, that might be the most important detail that drives a company to adjust what they're looking for in a facility. And if that's the case, then ownership or responsibilities are not going to be a question. They're going to relocate the facility to make sure that they're meeting those most important needs. If the facility doesn't need to be relocated and it just needs to be adjusted, then the responsibility is going to be dependent upon whatever the relationship might currently be. And I would say that's why you should focus on having a great broker on your side, just because you could enable a landlord to provide more capital into the transaction, which would, I would say, help reduce the overall cost and impact to the balance sheet that a company would experience when you have to go through with those adjustments.
Yeah, it's interesting. We have clients that we're working with currently who are, really utilizing this time to examine what their true requirements are for space. Historically, you can ask any local operator, they all want as much space as they can get. And once they get it, somehow, some shape, some form, they will utilize everything that they have. But corporations now are starting to realize that that's not necessarily the best way to do it. And in essence, it's important to figure out truly how much square footage and what type of space you need. So some of our clients have been able to look at things and say, okay, we have 1.5 years left on our lease term. We have double the space that we currently need. So we have gone to the landlords in a number of cases and simply stated, folks, we're willing to extend our lease at a longer term in exchange for a reduction in square footage so that we can, in fact, get the operation set up the way our clients truly need it to be. And so in a lot of these cases, depending upon the financial structure of the landlord, this has worked out very well, because a number of landlords are much more concerned with having long-term credit tenants versus having, a little bit more square footage leased to a company for another year, 1.5 years. So in a lot of these cases, we've been able to create a win-win where the landlord has reduced the square footage, maybe invested a little bit into new light fixtures, docks, doors, etc., and then the tenant in turn signed a longer-term lease. And in that case, it was a win-win for both parties. So those are really the items that we're trying to locate where we truly can get a win-win between the landlord and the tenant.
Sure. Well, let's take a step back here and look at a more basic issue that really has significant implications for the entire industrial real estate sector. I'd like to hear your thoughts about how the supply chain itself is changing. First of all, is it evolving to any extent? And let's talk a little bit about that. And I'd also like to hear your thoughts about the potential sources and destinations of imports and exports, how that part of the chain is changing as well.
Sure. So I would say this is my answer similar to the other question, the last question. It all depends on really the size, scale, industry, and current location of the companies that are in question. I would start off by saying also that we've gotten this question in the past because a lot of people believe that the impact of COVID, where it originated over in Asia, that it would cause a lot of companies to consider reshoring because of that. And interestingly enough, there have been a lot of companies that were questioning their positions in China already because of the trade war. And not only the trade war, but the cost and the rising wages to do business in China. So before this even started, that had been a question. And so it's been an interesting transition with COVID. It's just that, that new layer of how to look at the supply chain moving forward. And so COVID has caused a lot of these companies to say, okay, not only is it impactful to have our business in China and Asia and elsewhere, but we have a lot of risk. And what COVID did is it not only impacted demand for these companies, but it impacted the overall process. So they saw the amount of risk that was in their process. So as Pat mentioned previously, one of the bigger risks is your suppliers. What is their scale? How big are they? What is their capacity if something like this were to happen again? And so not only what is their capacity to handle and react, but also where are they located? How can they be impacted if all their facilities are in one specific market? So diversification has been one of the bigger, reactions. And then moving forward, not only with your suppliers, but additionally your locations, your company's locations as well. So how do we diversify and mitigate some of that risk? So, going back to the prior question, if you're looking at automation, it really reduces the risk and allows you to invest into the potential for reshoring. But if not, a lot of the companies are still looking at countries that you would expect them to look at, frankly, but maybe not focusing solely in China. So I would say some of the names that we've heard are, Vietnam, Thailand, India, Indonesia, and many others. Again, it just depends on your specific operation and sourcing of goods.
Yeah, I know one of the particular industries that has been getting a lot of the attention have been the pharmaceutical industry. And you start looking at it and say, do you need to have these products being brought over from the other side of the world? So as a result, I think as we've all seen, not only with these companies racing to come up with vaccines for the coronavirus, but we've also seen a lot of these companies really increasing their research and development here locally in the United States and in North America, which in turn is going to result in additional distribution within the North American market. Might not fully replace what is in other parts of the world, but at a minimum, it is going to supplement what is in other parts of the world so that we don't get caught in the same situation again.
I just want to add one quick point as well. Between what do we do with our facilities and how do we adjust our facilities to be more efficient, to gear towards the new norm after COVID, as well as where do we locate and what countries are we located in, where is the risk from that standpoint. I would say that we've also heard there's much more of a heavier focus on this concept that we're talking about right now, just because a lot of these companies have been dealing with suppliers that are going out of business and they need to figure out how to react to them first. Additionally, no one is really sure what the future implications on trade might be as a result of COVID. And we are also in the process of dealing with an upcoming election, which could impact some of those trade questions as well. So again, it's hard to make substantial adjustments to facilities and supply chains when those questions are up in the air.
Because that brings in not just the actual facility itself, but we're talking about potential incentives that are going to change, potential taxation, which is going to change. And when you start throwing these things into the mix, certain areas which are currently economically strong and, would be on the short list for groups looking to open up new facilities. That may change overnight. And so all of these things have to be put into play, because no matter what, even though there's so many different variables that are now in place for companies trying to figure out where they want their distribution and manufacturing facilities to be located, the one thing that's never going to change is cost. And just because something might seem like it's in the right location, if because of lack of incentives and additional taxation, higher labor costs, et cetera, cause the overall operation to be more costly, that location likely will not be selected, where, a year earlier, it may have been a home run.
Well, certainly, as you both pointed out, plenty of moving parts in that area, literally when it comes to location considerations. And well, I really appreciate those great insights. And we have a few minutes left, so let's move on to some questions from our audience. And the first one here, interestingly enough, also deals with location in a sense. And an audience member asks, do you see last mile industrial facilities expanding beyond being located near densely populated areas like the Northeast or California to places in the Midwest? So how about that? Do you see any significant location shifts in terms of last mile facility preferences among operators and developers?
That's a good question. I think this is such a stereotypical answer, but I was going to say I think it all depends. There's constant adjustments that are occurring, and when you talk about last mile for grocery goods and refrigerated goods that are going to grocery stores or going to end users is completely different than items that are coming from some retail store, right? And so what you see is it's all going to depend upon the centroid of what you're delivering to. So a retailer might look at their population base and their customer base much different than a grocery company would, as well as the pharmaceutical companies that are supplying hospitals. So I think it will adjust. I think it will adjust as our preferences adjust. I always joke around and say in Pittsburgh when I'm touring, when the world ends, come to Pittsburgh and you won't have to, you'll get an additional 10 years of life because we're that far behind the time. And I think what's happened with this COVID shift is now we have everybody buying their grocery related goods online and ordering them. And I think that trend will continue to shift for every other retailer as well. So I think, again, it will depend on exactly the type of good that's being distributed, but it's only a matter of time to see how that's going to impact the rest of the supply chain for some of these companies.
And it's interesting that Amy mentioned Pittsburgh, where we're both located. So my gut reaction is, yes, it is going to change for the Midwestern towns, because just within the past couple years, we got some of the newest big box distribution centers in our market that we've really ever seen, because we are literally right in between the Columbus distribution market and the Lehigh Valley distribution market. So as a result, we didn't have these major big boxes, but we've had some of the national developers in over the past couple of years opening these facilities. And I think they were smart enough to see that this is a trend that's going to happen. And candidly, because of COVID, I think it's only going to continue.
Yeah, and I would just like to add to that as well. I agree. The demand has been there for quite some time. So the requirements have pre-existed this transition. Now it's just how much will this transition impact what was already in place? So does it get closer? Do they adjust exactly where they locate this facility? And again, it's all going to be dependent upon product.
Sure. Well, let's go to our next audience question then. And I think this is kind of a two-parter, so you can take it on any way that you like, of course. And so our audience member asks, do you expect cap rates for triple net e-tailer warehouses to go up? And then I think the second part of that same question is, how will CMBS trends adversely affect these?
That's a good question. So I would say yes, dependent upon the retailer, just because there's a lot of unknown right now. and so you have to be very secure in your tenancy and understanding their checks and balances and cash flows and credit and everything moving forward. But I do believe that the demand for industrial will continue to outweigh any other property sector.
I think. I'm sorry, Amy.
Go ahead. What's that?
I'm sorry. I was just going to interject. Piggybacking on that, credit is absolutely the key, because it's not just the retailers that we're hearing are heading into bankruptcy. The major credit bureaus have reduced the credit rating on some of the biggest names in the retail industry over the past couple weeks. So until those credit ratings go back up, I think it will be very, very difficult for cap rates to become stronger, because as we all know, it's not just the facility, it's the credit and term of the tenant who is leasing that facility. So that's still a major unknown scenario. And CMBS is the exact same situation. We're just starting to see what is going to happen and how, a number of, office building owners are getting their hands tied up by the financing in place. Hasn't really gotten to that point yet on the industrial market, but, there's still some unwinding that's going to need to take place over the next 60 days.
And I would say the financing too is the biggest negative is the unknowns, and how do you value and understand the value of a property moving forward when there is so much fluctuation in the market right now.
I think we have time for one more question from the audience here, and it's kind of getting into the weeds here a little bit, so I'll toss it out to you, and you can tackle it any way that you want, certainly. And our audience member wants to know, is there an estimate of how many square feet are currently occupied by non-food retailers on a national basis, and what percentage of that is likely at risk? And I'm assuming that the audience member is referring to square footage that is, in warehouse and distribution space that is occupied by those non-food retailers on a national basis, and what percentage of that is likely at risk. So, you're certainly welcome to take that on however you see fit, but if you could give us some perspective on that, on the, again, non-food retail occupancy at, I'm assuming, distribution and warehouse centers.
Yeah, that is a great question, because that's in my mind kind of when I talk about the market and the implications moving forward. I do not have the exact statistic. I'm sure somebody does have that statistic out there that they're watching, and I think that's where you have the unique conundrum moving forward. There's going to be a lot of continued demand for industrial space because, again, the growth of e-commerce has pre-existed itself, and now it's really been a cannonball effect because of the increased demand from grocery as well as convenience items and pharmaceutical items that companies need more of. And so, the retailers are going to be the biggest question. And again, they're, as a lot of these stores close, there's going to be a lot of warehousing space that comes back to the market because the need just isn't there now. Some of them are going to go bankrupt and it goes away altogether and increases the amount of space, but then there's going to be some mergers and acquisitions too that also increase the amount of space. So that number I do not specifically know, and I think that the biggest question that a lot of groups are fumbling over is how is this new demand going to replace everything else that is currently going vacant, and how much spec development will continue to occur. And I don't think there will be much spec development until there's more security, until financing markets stabilize as it pertains to this as well too.
And that's a difficult number to come up with, because what we've seen is a number of the major retailers who are involved in e-commerce are involved with many different facets of product, including food. There are certain companies that you can go into and get your dry goods as well as your groceries. So how to break that out from what it has historically been to where it is today, it's a big question. So candidly, I think that number would be very, very difficult to, pull up without really diving into greater detail into the individual tenants themselves.
True.
Well, we are just about out of time for today's session, so we'll have to leave it there. But a quick reminder to our audience that we'll be notifying you by email when the recording of today's session is available. And remember to tune in every Thursday for Snap Sessions covering important issues for multifamily and commercial real estate. But let me give my great thanks to our experts, Patrick Senter and Amy Broadhurst of SIOR and, of course, CBRE. And thanks for your time, and thanks to everyone in our audience for listening in today. Hope you'll be joining us again soon, and have a great day.
Thank you.
Thank you very much, Paul.